Welcome back to the program. In case you're just joining us, it's still our continuing coverage of the 2023 IMF World Bank Spring Meetings in Washington, D.C., the United States of America. I've told you a few times on the show that the IMF as well as the World Bank, the two Bretton Woods institutions that were established in 1944 after the Great Depression in the 1930s, have been coming together twice a year, the spring meeting as well as the annual meeting, to have talks on global financial stability, monetary policy, fighting poverty, and some of the other challenges that have been plaguing the world. In fact, at this meeting from the IMF as well as the World Bank, it's been said that the world is going through crisis upon crisis, one shock or the other. Now, we will be taking you through excerpts from the IMF briefing concerning Africa, but I'll just give you a few hints of what the report says, a big funding squeeze that is impacting Africa, and I also do think that our policymakers should take this seriously. Some days ago, I've always also told you that Nigerian policymakers are here. The finance minister, Zainab Ahmed, as well as the central bank governor, have been representing Nigeria in different high-level meetings. But if we take a look at a summary of what the IMF has said in the report for Africa, some things that we really need to take away. A funding squeeze has hit the region hard, and the funding squeeze are aggravated, protracted trend that has been years in making. The IMF is also of the view that public debt across the continent is increasing. If you take a look at Nigeria, for example, Nigeria has a debt, according to the Debt Management Office, of 46 trillion naira as of December 2022, that is expected to rise after the ways of means of the central bank are securitized. What will that tell us? That we will have a debt problem of close to 70 trillion naira. But let's quickly take Abebe Selassie, who is the director IMF, who is the director African Department at the IMF.
Education, of course, infrastructure. This will not only impact them now, but also in the years to come, as by 2040 or so, a third of new entrants, new labor market entrants, will be from sub-Saharan Africa. Skilled, educated workers will be vital to the health and stability of the global economy, but today's funding squeeze may impact the region's ability to provide them. I've always said that this is the African century. But if measures are not taken to address this funding squeeze, now the region may be held back from developing its potential. Here at the IMF, we're playing our part. As of last month, we had 21 lending arrangements with countries in the region, and with still more programs under request and under discussion. And between 2020 and 2022, we provided more than $50 billion through programs, emergency financing, and special drawing rights allocation. We're also, of course, continuing to provide capacity development and technical assistance and training to our members, and we'll continue to do so in the coming months. In terms of policy priorities, we are flagging that there is a need to first consolidate public finances and strengthen public finance management. This will rely on continued revenue. This needs to rely on continued revenue mobilization, better management of fiscal risks, and more proactive debt management. In countries where debt levels are elevated and debt is clearly unsustainable, restructuring is going to be unavoidable, and a well-functioning debt resolution framework will be vital to create the required fiscal space. A second priority is to contain inflation. The inflation rates are varied across the region, but remains elevated, much more so than we've seen it for many years now. And monetary policy needs to focus on keeping inflation firmly on a downward trajectory, and make sure that it returns to central bank's target range. Third, I think, is a need to allow, in those countries where exchange rates are flexible, where the rate is flexible, the exchange rates to adjust while mitigating adverse effects on the economy. And then finally, climate change is, of course, increasingly something that is weighing on policymakers in the region, on our people, and tackling this, including with support from the international community, will be very, very important. The region is not a source of emissions, as you know, but rather it's on the receiving end of a lot of the climatic changes that are taking place, and pursuing policies to help with climate adaptation and mitigation in a few cases where that's a challenge will be important going forward. Let me stop here and
we will. Thank you. Thank you.
So on fuel subsidies, as I said earlier, I mean, how and whether to subsidize and to what extent, honestly, is a very deeply domestic and deeply political question. If governments want to do that, that's fine. But we think it's suboptimal, as I said, for reasons I explained earlier, that the benefits of subsidies tend to accrue to richer households. But if that's what government is deciding, that's fine. Removing them also, I think, is of course part of this, political and domestic debate that needs to be had. We know, of course, in Nigeria that fuel subsidies eat up tremendous amount of resources. At the same time, that the government doesn't have resources to address the huge investment needs from health to education to infrastructure. But this is a choice for Nigerian government, Nigerian civil society to make. We've also heard the discussion that's going on, the debate that's going on whether this is ideal. We try and inform that debate with numbers, with practices elsewhere, and I think that's our role, and look forward to whatever decision the government takes. On debt, again, whether debt is sustainable or not, is not dependent on just one number, one threshold, but rather, really a lot of. You have to look at a lot of indicators to assess, the trajectory, whether debt will be sustainable in the coming years or not. And I think, it's really, when we make an assessment and we classify countries as being in a moderate risk or high risk, or we talk about vulnerabilities being elevated, it takes into account, what we think are the kind of policies that the government's going to pursue, and of course, certain assumptions about the global environment. The last several years has been full of shocks, so it has made countries' ability, to bring debt on a sustainable trajectory more difficult. But, they've been compensating for that also with stronger economic policies. So for a country like Nigeria also, the future trajectory of its economy is going to depend on a whole host of variables, the reforms that the government pursues, how effectively it uses the resources it has, the oil price trajectory. So it's a combination of those factors that will determine the sustainability of Nigeria's debt. Right now, it looks manageable, but it's really also important, of course, and contingent on what policies will be pursued in the coming months and years. I think as always, the extent to which monetary policy will help, address inflation is going to be dependent on a whole range of factors. I think if you have largely negative real interest rates, I'm not sure that that is conducive to the kind of signaling effect that you want to have, either in terms of supporting the exchange rate or the credit channel. When you have multiple exchange rates, that also becomes a lot more complicated, right? I mean, which exchange rate do you use as a benchmark? So, all of those things have to be factored in. Again, we are not absolutely dogmatic that it always has to be about interest rates increases. So that will work through the credit channel, as you said, for a large part, some by mobilizing a bit more savings. But, there are cases also where we support, managing liquidity. Even other cases where the financial markets are even more rudimentary. So outright monetary targeting, explicit money targeting is what will work. So I think it depends on a combination of those factors. And, I think you have very nuanced policymakers in Nigeria, I think, that understand that. We think that way. Yeah? So on inflation, on the inflation challenge, again, this tends to be, of course, unless you're part of a monetary union, there's a lot of variation in inflation and also a country-specific assessment that has to be done on the causes of inflation. So yes, to a significant degree, we've seen imported, the pressure on inflation has been imported. So if you're an oil importing countries, you're facing higher international oil prices, right? And depending on the extent to which it's being passed on, that's a source of inflation. Similarly, food prices having been elevated after Russia's invasion of Ukraine, that also is a channel through which inflation has risen. But, as we look across the region, there are also countries where clearly it's domestic demand pressure or monetary policy having been loose in the recent past that is causing inflation. So, I think you have to look at the totality of those factors. But, increasingly, I think what we cannot say is, things like interest rates do not work, raising interest rates do not work. I mean, of course they do, because, that's the standard monetary policy response. And our economies are now, more so than in the past, I would say, a lot more influenced by, the normal way in which monetary policy transmission works. So I think, raising interest rates is part of the answer to addressing inflation. But again, how you calibrate that depends on country-specific circumstances. OPEC oil price increase, as always in sub-Saharan Africa, it will be asymmetric. In general, it will be negative because, I think out of the 45 countries, only about 8 are net oil exporters. So those other things being equal, whether you have subsidy or not, etc., should benefit from higher oil prices. But for most other countries, it will be a source of, a negative shock. So it will amplify imports, foreign exchange demand, and at the margin also inflation. So, good question on the thought process that goes into what we highlight. This, of course, again, as I say all the time, a very heterogeneous region. So really, the circumstances differ incredibly across the region, from growth to fiscal outcomes to the debt picture. And, a lot of the conversation, though, about Africa, the narrative has been about debt. And indeed, the debt vulnerabilities are the most elevated they've been in many years. I would say maybe even since the turn of the century. But one thing which we felt was not enough attention had been paid to was the role that the scarcity of financing from external sources was playing. Yeah? So we're titling it a big funding squeeze because that right now strikes us as one of the big cross-cutting challenges that many countries in the region are facing. So, debt levels go up as a result of what fiscal policies governments pursue, first and foremost, but also whether countries have access to favorable terms of financing. And over the years, official development assistance, which was a major source of financing for sub-Saharan Africa, has been declining. Countries have instead been relying on more costly forms of market borrowing, of course. And these are also factors that have contributed to debt levels rising in the region. Last but not least, right now we're at a moment when countries do not have access to funding markets from outside. So this exacerbates the situation, and there are countries that are not facing fundamentally a solvency problem, but rather a liquidity problem. And because of exogenous circumstances, even these countries facing liquidity problems may fall afoul of debt sustainability considerations. So we wanted to highlight the complexity of the story and also identify and draw attention to the fact that we need to support the region, including through significant counter-cyclical financing of the type that international institutions like this provide.
We'll take one on the first row.
My second question. Oh. Can you talk about some of the
Oh, so, again, region is, as I said, quite heterogeneous. And, I also want to stress we're a resilient region, and I see sources of resilience, particularly in the private sector, even in countries where the public sector is facing balance sheet problems. You see quite a lot of resilience in the private sector across the region, really. And in terms of countries, you also see very inspiring projects being discussed. So I've been meeting delegations. Yesterday, for example, I was hearing about the green hydro project that Namibia is launching. So there are a lot of bright spots in the region also. On growth and whether we can still say the region is an attractive one. I mean, I'm a little bit partial, of course. I mean, biased, of course. So I'm going to answer that in the affirmative. I think the potential of the region is perhaps the least tapped globally. So I think investment opportunities are galore. Why aren't these investment opportunities not being taken up? Partly on account of policy, partly information asymmetry. So there's a range of factors that have to be addressed. Sometimes it's the lack of infrastructure. But, I have absolutely, no doubt about the potential of the region. So, I mean, it goes back to, I think, something that we've been flagging over the last many years is what we saw in the last 10, 15 years is indeed growth that has been influenced much more so by, government spending, the investment in infrastructure, in health, in education, and we need, a handover of growth from the public sector to the private sector, and the policies that are going to be required will vary from country to country. Yeah? So I'll leave it. On the growth projection, I mean, it's largely being influenced, of course, by the electricity production difficulties that the country is having. So I think that's by far the most important influence in the projections that we have. Of course, the external environment being difficult is a factor also. I think 0.1 is the number we have. We think other things being equal, probably the country will scrape through with a small expansion, but honestly, I mean, there's a big confidence interval around that. In terms of the financing squeeze, I mean, one of the great things about South Africa, and that has withstood it well over the years, of course, is the fact that it has deep and liquid financial markets, and the government, almost entirely relies on this market to fund itself. So that's a source of quite a bit of strength for South Africa. In the past, global financial crisis, for example, in 2008-9. The country was subjected to a really big funding squeeze, but managed it by allowing the exchange rate to move and relying on domestic markets. So I think that is an important funding source that will, I think, see through both the government, but also private markets who can also rely on this private companies that can rely on this market. So I recuse myself. Honestly, because I think I've been saying this to people also. I'm privy as much to information from anecdotal sources as I am of just professional sources. So I think it's best to allow my colleagues that deal with the country to give you the full picture. So it's not because of any malign intent or issue. Second, on Nigeria. Again, I think there's a lot of speculation about what's going to happen, what's not. I think it's really difficult to respond on hypotheticals. I think a source of frustration for the government itself, policymakers, businesses, over the last several years has been that the trade regime, the foreign exchange regime, have all been very challenging and have not allowed Nigeria to robust the very strong, rates of growth that the country needs desperately. So, second, I think it's appropriate that you look at policies in terms of their effectiveness. So a question that we have is these the policies that have been pursued over the last 3-4 years, have they indeed helped achieve the diversification that it was intended to achieve? So I think, you know, the new administration will see what they do. We would be supportive of measures that are, you know, policies that respond and are effective in terms of addressing the diversification objective that Nigeria has, but also addressing the near-term challenges that, you know, macroeconomically the country is facing, from revenue mobilization to, you know, ensuring that there are sufficient resources to spend on health, education, infrastructure. So, you know, I think that's all I can tell you. On the Horn, absolutely. I mean, we are very worried about, of course, the, you know, on top of the global challenges that the countries on the Horn have been facing, they, you know, the drought has also been a very important source of drag on growth, but more, you know, we're still on the well-being of people, and it's something that, you know, all of our programs or discussions with the countries on the Horn takes into account. We have a small section in our an annex in our one of the analytical focuses on potential implications of these fragmentation type tensions on the region. So I will ask you to look at that. Do we have a functioning sovereign debt restructuring framework? I mean, really important that, you know, I think the creation of the common framework was really a very, very important initiative. We didn't have a framework which brought together outside the Paris Club, you know, all official creditors. So the fact that it was created, honestly, was a fantastic initiative, and I'm not sure would have come about absent the pandemic. So the urgency that created, the moment, I think, allowed the common framework to be created. And really important discussions and conversations have been taking place. So relative to the, you know, the architecture that we had 3-4 years ago, you know, the DSSI and then subsequently the creation of the common framework has been a really important one. And we have had some success. I mean, I think Chad is, of course, an important example, but also it was under the common framework that, again, and the assurances that we were provided that we were able to proceed with the, you know, presenting the program on Zambia forward. But the common framework is being, you know, it also needs, of course, to be a lot more timely in terms of facilitating final restructuring outcomes, and that's what's lacking. And what we are urging, you know, what we are urging when we flag that we need much more nimble, much more agile, you know, debt restructuring framework for countries that already are facing debt difficulties and down the road may need some. In terms of overarching approach to debt restructuring, I think the complexity of the creditor base now is going to lead to more and more work at an individual country basis rather than cross-cutting basis. I think we see you know, how different the debt treatment is going to have to be in Zambia versus Ghana, for example. So I think, you know, going forward, I think we will be seeing more country-specific cases, and again, strengthening the need for you know, a mechanism globally that is much more efficient than the one we have now.
All right, welcome back. I guess it's a wrap on the show. We've been giving you back-to-back, you know, coverage of the 2023 IMF World Bank spring meetings here in Washington, D.C. It's been a week long of engaging conversations, brain-stimulating conversations, inspiring conversations, motivating conversations, as well as deep thinking conversations. And I do hope that for our Nigerian authorities that have been represent the country here, when they go back, they get a few of the solutions and recommendations, but it's going to be hard. And as Nigerians, are we ready to take the hard decisions? I'll see you all again next time. I am Nancy Naji. Be the best you can be, and be the change that you want to see. Bye now.